Hello and welcome to this edition of the video market update from Orbex.com. Beginning with the biggest event of last week, the Federal Reserve Chair Janet Yellen gave the market another hint regarding the pace of the rate hikes this year, keeping March meeting alive for a possible action. But in the meantime, the Fed Fund futures are pricing in a 70% chance for a rate hike in March meeting. However, the US dollar index also eased most of its weekly gains on Friday. And there are several reasons for such a move. The first one is that one of the Federal Reserve members noted that there were no significant data between December and March to justify a rate hike in March, which could possibly mean that the March meeting will show a split between the members. The second reason is basically the resistance key, or the key resistance area that we noted in many of our reports on our previous videos, which stands between 101.70s to 102, where the dollar index tried to break above that resistance, but at the same time ended the week lower, and the index managed to retreat and decline all the way back and closed the week even below that support, which keeps the potential head and shoulder pattern alive for now, which basically we will take a look at it later in this video. Another interesting move last week was from gold, or in gold and silver, where both reached our entire targets mentioned in our previous report and also during the webinars last week. And after that, we saw a notable correction to the downside, and we also already warned the traders that gold and silver might be on the edge of another sharp correction. And in today's video also, of course, we'll take another look at those assets. We have also the Aussie and the Kiwi, who made also an interesting move last week, declining back from their key resistance areas while we wait for the RBA decision later this week, which could be, or which should be, quite interesting for the Aussie. As for the week ahead, there are several economic figures and economic events that you need to keep an eye on, especially or beginning with the RBA decision on Tuesday, which is set to keep the current policy unchanged with rates also, but likely to keep the sentence that says that Aussie is still overvalued and would complicate the economic adjustments, which might be the catalyst for another leg lower in Aussie pairs. On Thursday, we will be waiting for the ECB decision finally, which might be another interesting event, especially after the inflation figures, which basically came in much higher than expected in all over Europe. Despite the fact that the ECB also promised the world to taper in April, there is a possibility to do so in March, which would be also a positive factor for the euro. So you need to keep an eye on, and we will definitely be also, we will publish a special report about the ECB decision in the next few days. Finally, on Friday, the USB jobs report will be released, and estimates seems to be stable. Non-farm payroll set to add 185 new jobs, 1,000 new jobs, while the unemployment rate is set to ease back toward 4.7, down from 4.8. However, what matters in this report again is the average earnings, which may rise by 0.3%. However, for the past two reports, or for the past few months, wages have been slowing down, and if we see another slowing down in February, March meeting or March rate hike might be off the table. So these are the most important events that I wanted to shed light on at the beginning of the video, and now let's take a look at our technical charts. Beginning with the US dollar index, and as we noted in our previous videos, there is a potential head and shoulder pattern, which is here we're talking about the left shoulder, and then we have the head, which is around like 103, 103.50s, and then we went all the way back down, and now we're testing that resistance again, which is around like a 101.70s, 101.80s, all the way to 102. This is a potential resistance zone, and on Friday we managed to break above that level. On Wednesday and Thursday, break above that level. We closed the day actually 2 days above it, and then on Friday, despite the fact that Janet Yellen said, as I said in the beginning of the video, despite the fact that Janet Yellen kept the door open for a possible move in March, the dollar index went back down also and closed the week below that resistance, which keeps the potential head and shoulders on the daily chart alive for the time being. The technical indicators doesn't look that much positive for the time being, especially that the stochastic indicator is almost at reaching almost an overbought area, and at the same time the RSI is basically back lower and almost trading at 55. So I still believe that we will see some another consolidation around these levels, but for the time being, I still believe that we might see another leg lower in the next few days. Going into our the most interesting charts for this week, beginning with the New Zealand dollar. Finally, we've seen, as I said last week, or for the past few weeks, we tried to break above, or to post a breakout above the key resistance area here, and then it failed for 1 week, second week. The third week was a doji sign, But last week was the break lower, and there's the very important here is that the 50-week moving average is now above the price. So the candle here, the weekly close, basically opens the way for further declines ahead. At least we might see another decline all the way back toward 69.50. The 70, of course, is a very important level to watch out. But for the time being, we have the 70 and also 69.50, a very potential level to look at in the next few days. Also, the technical indicators are not quite positive, including the RSI, which is we're trading right now almost below the we're below 50s, 46, and also the stochastic is clear to the downside. So daily, weekly are also bearish and negative. We're expecting more downside ahead. The Aussie has the same pattern almost, but the good thing is that, again, as I said for last week, we had 1 to 3 weeks of a failed breakout or a fake out, we might say. And last week we have the leg down or the leg lower, especially as I said after the RSI was flat for the past 3 weeks, and the technical indicators are heavily overbought back then. So this was a potential sellers, a potential short since almost last week. But for the time being, we still need another push, which might come during the week from the Reserve Bank of Australia, especially if they kept the door open for further actions against the Aussie, because the bank is not happy actually with a strong Aussie, because due to the bank is saying that it will complicate the economic adjustments. So the next level we'll be watching in the next few days or during the week is basically the 50-week moving average, which is standing about 75.13, and the price right now is 75.90. The euro also made another interesting move actually last week. We tried to break above the 50-day moving average since last week, but beginning from Monday to Tuesday to Wednesday to Thursday, all the way back down. But on Friday we had this huge run up all the way back up to the 50-day moving average, right above or right from its 61.8% Fibonacci from the recent rally that we've seen this year, or since the beginning of the year until today, or until the top here. Back in the end of January, beginning of February. So for the time being, this is a very bullish sign for the euro, especially that the dollar index is also not quite positive, and the 50 or the RSI is trading above the 50. Crossover to the upside on the in the stochastic indicators, which basically shows that there is a potential or another breakout might be possible. And if we even throw a trend line in here, the trend line basically most of whether you're going to take it from here or the other way, both ways it shows that there's some sort of a breakout here. So I still believe that the euro has potential to rise further. With the stop maybe below yesterday's or last week's lows, it is actually possible. The dollar yen, going to the same charts, it made a breakout right above from its 100-day moving average. Again, the moving averages are really good to watch, and they're very good to watch. 100-day moving average, it was on Tuesday, and then we've seen the Wednesday, Thursday, and Friday. But Friday also stopped the rally at the 50-day moving average again, because also the dollar index went all the way back down. So right now we'll be still watching here, because it might be a double top formation at the same time with the dollar index. Also building a head and shoulder pattern. This could be also another stop for the dollar yen before declining all the way back down. Potentially we'll be looking for another leg lower, at least for or toward a 12 or 112.60s. Going to British pound, as I said, it's still weak. The strategy remains the same, selling on rallies as much as possible, but for the time being, especially right now, and after we broke below the 50 and the 100-day moving average, here I would suspect another rally to retest those moving averages, especially the technical indicators are heavily overbought. So I would be interested to see another rally all the way back to 124, 124.50s, or even 123.90s before the downside continues, and we still believe that we might see another downside. This is despite the fact that dollar indexes might be bearish, but the British pound is still one of the weakest currencies in the world due to the Brexit uncertainties. Gold and silver. Gold continued, or beginning with silver here. Silver went all the way back down from right from its 50% Fibonacci from the recent decline that we've seen since January 2016, all the way back down, and then we've seen that bullish cycle, since the beginning of December of last year, and we topped actually at the 50-day moving average for the past, we've seen 1, 2, 3, 4 days with no breakout, and then we've seen another decline all the way back down. And this is again one of the moves that I'll be looking for before looking to buy again, despite the fact that the technical indicators are still pointing lower. But this is still a good chance for another dip buy in the next few days. I still believe like any downside risk would be very limited above the 50 or the 100-day moving average in the next few days. As for gold, gold also made it a very clear decline all the way from its 200-day moving average, the one that we mentioned also last week. Since then, we touched the 1260s, and then all the way back down. We reached even last week on Friday, we had almost the 1220s, but at the same time, we closed the day on a doji sign. This is still a positive sign to look for in the next few days, and also is still above the support area that we mentioned it also, which is here, 1224, 1234. So keep an eye on this level also, because I still believe that gold still has more potential to rally in the next few days. We're not going to talk about the U.S. equities this week because, again, I mean, for me, there's no point to talk about the U.S. equities with this massive rally, and that continues to rally despite the fact that the Federal Reserve is expected to raise rates at some point this year, maybe March, maybe after, or maybe April. We don't know. But this kind of rally, again, it's risky. It's very significant, and we don't know where it's going to stop. So I would prefer to stay away from the U.S. equities, and would still prefer the European equities ahead of the elections, ahead of the Brexit. There's many potentials there, and we will be basically talking about it in the next also videos. And sometimes we'll do some special videos about the European equities and how to trade them in the next few weeks. So this is it for today. Thank you again. Thank you all for watching. And if you like this video, you can like and share it on your social media platform. And if you have any comments or any suggestion or any feedback, you can leave it also down in the comments. Thank you for watching. I'll see you once again next week with new videos and a new analysis. Thank you for watching.